When I was a kid, I used to make models, little models of, they're mostly ships. I had a good one of HMS Victory.
I'm mostly into princess castles myself lately with
one?
my daughters.
Which one? Arendelle from Frozen, the one where Elsa lives?
I think you could pop any girl into one of those models, and out would pop a princess. I think that's what models do.
It sounds a bit like an economic model. You put in some inputs and some statistics, and it pops out something that tells you something simple. Something complex turns into something simple.
Or vice versa. I think something simple put into an economic model can always turn into something terribly complex, which is why I've always been terribly afraid of economic models whenever anybody mentions them.
Don't fear, because you have a dictionary of finance to make these things simple for you.
Oh, so
or at least clear.
So we're going to be talking about economic models.
Yes, we are. Today on a dictionary of finance, economic models. So we're joined by Natasha Avila on this episode of A Dictionary of Finance from the European Investment Bank. Natasha is the head of policy and strategy in the economics department here. She's also a musician and in fact has something of a background that connects her music, which was when she was a student, with economics. How did that come together? It was just recently, right?
Well, a few days ago, I was speaking at an economics conference with high-level central bankers asking ourselves whether inflation would ever come back. And actually, it was on the stage of a music hall, which was the place I first gave my first concert with an orchestra some 20 years ago. So it was a very emotional experience. And actually, the economics discussion ended up being very inspiring.
Really? Like the music? Emotional and economics. We also have Georg Weiers, who is a senior economist in the policy and strategy division here in economics. Do you find economics an emotional thing? Is that why you got into it?
No.
How did you get into economics?
I was studying something else. I was studying aviation and space technology together with philosophy. One is very concrete and very applied, and the other one was very fluffy. Economics was somewhere in between and promised to answer different questions.
So we're going to find out today where in between it lands, between the fluffy and the concrete. But, it's good. I'm sure our listeners will be inspired, talking of inspiration, to know that economics is more inspiring to you than space.
Indeed.
Right? We're not broadcasting this to 7-year-old boys because I think they might disagree with you, but nonetheless. Let's start, Georg, with you. We're talking today about economic modeling. So what really is that? Is it something that's theoretical? Is it something that's empirical? Is it concrete or fluffy?
Yeah, probably somewhere in between. You try to replicate something concrete by something very abstract. You try to understand how things work by building a model that reflects of how things work that you cannot observe directly. And this is why we did the economic modeling.
Mm-hmm.
Also.
But when you do that, so if you build a model, I guess this is a model in a computer, right? And you build it, and then you see if the real life follows that model, right? So do you then, if the real life turns out different, do you then do small corrections into your model to make the model more lifelike?
To some extent, of course, you adjust it. If it doesn't deliver what actually happens, then you have to adjust it. Unless, of course, a model is just sort of a subset of what you're looking at. If other things are influencing it and your model is still sound on a general principle, you leave it as is and try to complement it by other things. But if it doesn't turn out true, maybe either you're missing something or you have to adjust the model.
But how do you make one? How do you make this model? Because let's say if you're a 7-year-old boy and you're interested in space, you can make a model with Lego of a rocket. We know what it looks like, we know the shape, we know how to do it. But how do you make an economic model? Where is it? What is it?
Well, fortunately, we're not the first trying this. So a lot of people have tried it. There are a lot of blueprints of things that have worked before. Other things people have discovered that they work. So we use this as a baseline and try to adjust this as much as possible to fit the purpose that we want to use it for.
But it's not made out of Lego. What is it?
It's a little bit like Lego. It has certain elements and components you put together, certain behavioral assumptions of how people behave, certain economic equations that you have to use or need to use to make it actually work. And then you put it together in a way. It's not that you're reinventing the wheel. The wheel is there and you try to build or adapt it as much as possible to the circumstances that you need it for.
But it's on a computer.
It's on a computer.
But what's on the computer?
A lot
is
of equations. So in this case, we have
equations.
1.1 million equations, I think, to solve simultaneously. And yes.
You know,
I'm glad you have the computer for that.
Yes. Having said that, economists need to simplify the world. And I think a model is a way to simplify things because we're not able to grasp everything. A phenomenon has many causes. Political, economic, social, natural, the environment. And as Georg was saying, there are different ways to models, and I would split that into two families, really. One is theoretical. You don't necessarily need a computer. If, for example, you say there's unemployment, right? There are people who don't have a job. It may depend on many factors. Technology. Is technology a reason for being unemployed? Labor costs. Is, working, does it cost too much? So you have a little function, so we need mathematics. A model is a mathematical tool, but you can write it on a piece of paper and solve it on a piece of paper. That's the conceptual, sort of theoretical approach. And then there's the more empirical approach, which, so far at least, because things are changing and we have big data and we'll speak about that, I'm sure, but which uses the empirical regularities of the past to infer what will happen in the future. And that's where we really need the, computing power and data management tools to make sure that this data that we inherited from the past can be analyzed and give us some ideas about what will happen in the future.
Can we give some examples of things that we might know about in general that are calculated using an economic model? You mentioned unemployment. Is the unemployment rate calculated using an economic model?
Not necessarily. Unemployment is rather something which is, quote unquote, directly measured. Mm-hmm. So we have things that are measured, so we collect data. For example, inflation. People go to supermarkets, they make a list of prices. They do the same thing with the same goods the following month and they compute inflation. So this is rather modeled. There are things that you cannot measure, as Georg was saying. I'm sure you have many examples, but the things you cannot observe, you cannot measure, you'll have to model them. For example, motivation of staff at work. You cannot measure that. You cannot, open someone and say, how, motivated have you been that month and what was your productivity on that month? So you'll have to infer that from what we call observables. And those observables, you collect them from how long you stay in the office, how many minutes you spent at the coffee machine, whatever you may want to use as an indicator. And then you can need a model to make a mapping between what you observe and what you cannot observe, so for example.
Plus, of course, the observed ones, if you want to project them forward, you need a model to what you expect them to be in the future. So the unemployment rate, if you measure it, you collect it, right? You count the number of people. But if you want to know what it is next year, you have to have some model in place to project it.
So, for example, just now in the United States, there's a debate about tax cuts and figuring out when they say, one side or the other in that debate says this will benefit the middle class by this much each year, or someone says, no, it's just for the rich, it's this much each year. They're making those projections based on an economic model.
Yes,
but a lot of these models, I mean, most of these are over time, right? We're trying to predict things in the future, I mean, a lot of people say that what happened in the past is not a good way to have an idea about what's going to happen in the future. But all models are based on kind of extrapolating from the past and making that figure go onwards in one way or another, right? So we're saying that basically what happened in the past will happen again, kind of in the same way in the future, right?
Yes, but then you do that every day, right? You expect the sun to come up the next morning. Economics it's more complicated, but certain things you want to identify which actually holds, which are patterns that actually sustain over time. That there are certain things that can come in, of course, that make the story come out wrong, but you try to identify the ones that are more stable and that actually give you a way to project forward.
Who uses economic models, to project forward? Who wants to see the future in economic terms?
Well, everybody would like to see the future, I think, but there are also a lot of models. But in daily life, you use it. When you go to the bank and look at your interest rate, if you want to take a mortgage, there is a projection on what the rate will be. You make assumption on what inflation will be. You make an assumption of what the economic situation will be. A company does that. Everybody uses these numbers, trustworthy or not, but you have to rely on something to make an informed decision. What you decide today will have an impact on the future.
So everybody's using an economic model essentially every day.
The results of an economic model, yes.
And even implicitly, households, when you're 20 years old, you contemplate the idea of making longer studies. You will arbitrage between, going to work right now, making money, or investing a few years, which hopefully will bring you to another, set of jobs, which will pay off more. So when you do that arbitrage, you do use implicitly an economic model, returns on investment in education, and you factor in a number of stuff. So you don't do it formally using a mathematical formula. The concept is very much the same. And in a sense, me coming with my mathematical formula, as you were rightly saying, the formula might have become obsolete because the world have changed. Mm-hmm. If you do it with something a bit more flexible, not formalized in the same way, you might be able to adapt yourself to the changes in the environment. And that's where we stand right now, I think, between generations of modelers who have relied simply on history and using history to infer the future, and things that are more adaptive, that are more able to adapt to changes in the environment. And the data, the richness of data that we have right now allows us to make that step. And a lot of the skills that we have learned as economists, as modelers, have become or are going to become probably worthless in a few years.
Right, because things are changing very fast. You mentioned they're adaptive and research and development. Technology, the technology that you can use to make these models work is changing very fast. Yes. So are there any models that we all kind of look at and view as important measures which might actually already be useless? Are there any things which people are starting to doubt? Maybe the way we calculate, inflation, maybe that doesn't really work so well anymore and we need to change it.
There's one big issue is productivity, for example. How productive are people at work? And we see developments in productivity right now that are puzzling. We have a productivity slowdown, so we don't seem to be as productive as we were, or at least the rate of growth of our productivity is much slower than it was before. So we ask ourselves, and one question is, do we measure productivity in the right way? And the second question is, do we model it in the right way? We almost know with certainty that we don't model it in the right way, and models of productivity are being improved as we speak. But there's also a matter of measuring it. Inflation, same thing. So a lot of people complain, does it make sense to go out to supermarkets and collect prices? Is it really what life is costing? Isn't there a better way to measure inflation? With big data, don't we have a lot more information about what people consume and how much it costs them and what's the cost of living? And I think those are very much open questions right now. We still don't have an answer.
But some of these indicators that you mentioned, productivity, inflation, these are things that are measured by dozens of institutions across the world in different countries. Like they all measure and model. Also, they try to project what's going to happen to these measures over the next quarters, next year. Do they model them in a standard way? So if you look at the central bank of a country and they say that we predict our GDP over next year is going to grow about 0.5%. Do you know which kind of a model they're probably using to come to that figure? Is there a consensus amongst you economists on how to do this, or do some people have like a secret model that they're not revealing to anybody?
So for some concepts that pertain to the public domain, there's no secret, but people don't necessarily agree. There's a huge effort being made and lots of people being employed in the United Nations, but also in central banks, in statistical offices, to make sure that people speak with the same concepts, so to harmonize concepts. So harmonizing the concept of unemployment, harmonizing the concept of inflation, GDP, economic growth, all those things. So there's an effort. There are some constituencies that have managed to agree on a common concept, but others have not. And so that's sort of stake, and it's something people sometimes have difficulties to agree.
But do we want everyone to agree? Because when I worked on in Wall Street, every bank or every trading firm would have the senior economist would come into the trading room in the morning and would go on something called a squawk box, where he'd say, these are the economic indicators that are coming out today. We think it's going to be this much, this much, this much, and this is what we think, you, the traders, should make of that. This is what we think is going to happen. But if you went from one bank to one trading house, and they'd all be different, and if they were all the same, they wouldn't have been able to trade. So is the fact that they're not all the same, is that important to financial markets, at least, if not to the economy?
To financial markets, I'm sure it's important. Everybody has their different take and everybody wants to be better than someone else. In general, I think it's a good idea to have different approaches to the same thing that sort of are complementary. If they are contradictory, you need to investigate why. If everybody uses the same model and if it's not accurate, then you more easily run into trouble. If you have different approaches to the same thing and they are highly divergent results, you need to investigate why. If they give you similar results, you have more comfort.
Now, I want to get into a specific example of something that you worked on, Georg, in a moment. But first, I wanted to just check on one term. Everything that we're talking about here, is this econometrics? Is that the term for it?
Econometrics, historically at least, had to do with the analysis of time series, whatever that means. Time series is something happens today, tomorrow, the day after tomorrow, and the relationship between those three data points creates something that can be modeled. As soon as you have 2 data points in time, you can, in theory, create a model. It will be very inaccurate, but that's the thing. So econometrics is the science, quote unquote, that links data that has no shape, no way to grasp the meaning and grasp, as I used the term earlier, causality, to structure that data and make a causal link between those data points appear through the analysis of mathematical regularities between those points. Though there are easier ways to do it and more complicated ways to do it, but that's more or less one way in which we could describe econometrics. And econometrics has been, flourishing because it's kept a lot of people busy. It's allowed us to have a debate on things. Will this happen or that? Your model is better than mine. Your model encompasses mine, so it's like mine but more general. So there were lots of branches that were on it.
Well, let me ask you a very specific example of something that you worked on a lot recently, Georg. So at the European Investment Bank, we lend billions of euros. Some of that is lent under the investment plan for Europe, so it's slightly different lending. But from all these billions, the bank said, we need to figure out if this is having an impact, right? Or how much the impact is. And then they said, go, do it. How on earth do you figure that out?
It's not that we don't measure impact. Clearly, we look at this also on a project-by-project basis. But there are certain things that we're missing. If you put a broadband cable underground, right? You know how many people you need to dig it up. You know how many kilometers of cable you build and how many people you connected. What you don't see is who actually built the cable or the machinery to put it underground and how much will it benefit the businesses. Now that you have faster internet, will new businesses spring up? Will others be sort of crowded out? What are the dynamics that happen indirectly? Since you can't measure this on a project-by-project basis, clearly we measure and report on the number of people used, the number of kilometers built, but the other things we can't really look at in each project. It would be immensely costly or even impossible. So here, this is one of the areas where you use an economic model where everything is interlinked. So this is exactly what we try to find out. So we looked around for which one is a good economic model, and here we're back at the fluffiness a little bit. There are a lot of economic models out there that you can use, and they give you slightly different answers. They look at slightly different angles of the same topic. So looking around of all the models that we could find, the most appropriate is a model used by the European Commission to assess the macroeconomic impact of the structural funds. Now, we're a bank, we don't provide grants, we don't tax people, we borrow on the market, so we had to adjust it a little bit. But then it seemed the most appropriate and suitable for our purpose to assess the macroeconomic impact of the EIB. Then we used millions of rows of data of ourselves to find really where is the investment going, what it is doing, which region it is in, over time when we're investing. And we, together with the Commission, we ran the model to assess what will be the impact on growth and jobs in Europe.
And what did you find out?
So we found by 2020 the EIB group supported investment will have increased GDP by 2.3%, and it peaks in 2020, but it still has a long-term contribution. So by 2036, in 20 years, it will still have increased GDP by 1.5%.
And also jobs as well, specifically jobs we're talking about.
Jobs,
in
I
this
mean,
model.
it's of course the interesting part. In addition to the GDP, by 2020, 2.25 million jobs. And over long, in 20 years, still 1.3 million jobs, more than it would have been otherwise. Of course, this in what we've modeled is we will just stop after 2016. Of course, we will continue and have investment. So these long-term effects do pile up, but you cannot just say 1 year plus the other one. 1 year plus the next one will not be double as much, but a little lower. There are non-linearities in the model. But yes, you are improving the competitiveness of the economy, which will have a lasting effect also next year on.
And those things get combined. What you finance this year and what you will finance in 10 years' time, there's a combined effect, which is exactly why you need a model, because you don't know what this combined effect will be, combination of factors. And what we're speaking about is GDP levels. So we're not speaking about GDP growth rates, but levels, right? So it's an amount of real money, so to say. But GDP is a flow. So GDP is an amount of money that is produced every year. So in a sense, it's sizable, but it's a realistic sort of order of magnitude. And this is also something where the economists, when using those huge models, and Georg was mentioning the number of equations, which is huge in this instance, the economist still has, at the end of the day, to exercise its judgment about the outcome and about the necessary assumptions that you have to make the model, able to run. So this is really something where the value added of the man at the end of the, chain to produce a result in terms of economics analysis is there. Is really in thinking about whether that makes sense and whether it's not completely, outrageous.
You showed me an academic paper about this model. The model is called Romulo, right? RHOMOLO.
Yes.
It looks, well, it is actually all Greek. In fact, a lot of it is in Greek letters, so it looks all Greek. But how simple is it to understand as an economist? When you look at it, do you read through those equations and say, oh yeah, I see how this works? Or do you have to go very, very painstakingly through every one?
It's a question of exposure. If you do this kind of modeling a lot, you'll recognize a lot of standard parts of this. There are components, how you look at labor, how you look at household behavior, that you can identify. Now, each model, of course, is somewhat specific. And then there is a question of experience with the model. We're talking about such a large model where everything is interlinked and everything moves at the same time. So this is not so much, you can read the equations and they make it all make sense. But in interaction of all the equations and all the interlinkages in between, you still can't predict the outcome. That's why you have to run it, right? There's certain grand assumptions where you think it should move in this direction. But what it will actually then turn out, you don't know. It depends on all the interlinkages in the economy.
Do you need a big computer to do that?
Yes. It takes quite a long time to run the model.
So you can't just open the file on your regular laptop and just run it on your regular Excel. You need a big computing power to make all these equations.
Yes, you can run it, but it will take you very long.
Mm-hmm.
So this is a huge model. So our listeners are not going to say, well, that's interesting. Let's go and look up Romulo and maybe I'll do that model. I'll run that model. But is there an economic model that's relatively simple and relatively well known and accepted that maybe if our listeners wanted to just go and play around with it, they could go and see how it works?
You can go and play around Romulo. One, it's all public, and they have an online tool where you can play around with it a little bit.
I would actually encourage to do that because it would demystify the fact that models are all black box. And you do have, it has an interface with human beings, so you have to input your stuff into the model. And when you do that, you see how things make sense. What you cannot see, and Georg explained it very well, is that there's no explicit relationship formula that you can write down and say investment is a growing function of the interest rate, actually the decreasing function of the interest rate in that instance. You cannot write that down. You cannot pin down the sign of the parameter because there are too many equations and factors and stuff, so it's never explicit. That's why the computer has to do it for you. But you can still, look at what happens when you put in, 10 more or 10 less. Where does that go, and how does it affect the rest of the equilibrium? Because there's another word that we didn't mention, is that this modeling exercise is an exercise which is a general equilibrium model. So everything is stable. Everyone is at his or her optimal. All the accounting identities are satisfied, and that's when the model gives its results.
So we'll put some information about Romulo and also some things that we wrote on our blog about the impact study that you guys did. We'll put that in the show notes so people will be able to read that, and in the blog posts around that. But in the meantime, I'm just measuring the time we've taken here, and I think we've reached the end of it. That is an equilibrium measure, I think, right? Where we try to make everything the same. Georg and Natasha, thank you so much for being on A Dictionary of Finance from the European Investment Bank.
Thank you.
We're going to talk now about our Twitter accounts, because we would love to hear from listeners on our Twitter accounts about what else they would like to be dealt with on this show, what else they would like to hear about, and potentially also their experience in playing around with Romulo, if they want to get in touch with us and say that they increased GDP by even more than Georg. That's plus or minus Georg. That's the measure that we're going to go for here. So I'm on Twitter at EIBMatt, EIBMATT.
And I'm on Twitter still as at Allartankler, ALLARTANKLER. And please do write, like Matt said, and do subscribe to our podcast and tune in next week.